we're looking at the data for October 2021, comparing it to a year ago, October 2020 and 2019. And I think what's of more interest is the overall trend and the shape of the curves as they unfold, of course. And it's certainly interesting times. In summary, we've seen a big jump again in median prices, a very big jump of $100,000 higher than the previous maximum. Previously, the maximum was $895,000 for the Wellington region. This is median prices achieved in February this year, and in October, after gosh, what's that? 6-7 months of median prices below $895,000. We've got a median price of $995,000. Have I got that around the right way? I think so. We'll see when the data comes. But so there's a big jump in median house price. So median house price growth increases significantly, but all other indicators point to a slowing market in terms of demand, number of sales happening, and less so the duration it's taking to sell. So let's have a look. So here you have median house price growth. The blue results, the bar chart is the monthly results, and the red line is the 6-month moving average. So you can see this number here is back in February this year. That was $895,000, and then March through to September, we had median prices below $895,000. So it was a clear flattening off, and you can see the 6-month moving average even moved down slightly for the month of September. And in October, we get this huge result of $995,000 compared to $785,000 October last year. Big jump, 27%. And so, you know, what does that mean? Is that a blip, or is that a trend? Well, at the moment, it's a blip because it's only one result, but it certainly is a big jump up. So it'll be interesting to see how, you know, what unfolds going forward. And of course, this is median prices. It's not some sort of stratified mean, or it's not necessarily an indication of underlying value. Over time, of course, the trend of going up does suggest an underlying trend of improving values or increasing values. But technically, of course, what the median is, as you know, is the middle sale price for the month. So if in that month you're selling an above average number of high value homes, then the median will increase without values increasing. And so we always look at the Real Estate Institute House Price Index, which is the best tool to strip out the mixture of houses that have sold in the month and tries to estimate the actual underlying house price growth or decline or whatever. And this is what that looks like. So in the last month, or in October, we saw 3% growth in Wellington. Now 3%, that is pretty strong again. We've seen growth in the last 6 months or so bumbling around between 0.5% and maybe 5% earlier on in the year. So 5.1% in the last 3 months and 32% in the last 12 months. And so for the last few months, we've seen the 1-year result come down from about 40. And the more recent results are underperforming the rest of the country. Excuse me while I let someone else in. So this trend sort of continues, but these results here, 3% for the month and 5% for the last 3 months, that is certainly stronger than we've seen typically over the last few months. And the next slide will show that. And so this is a graph here showing the 1 month and the 3 month Wellington House Price Index growth since February. So in February, it was absolutely massive, and we saw a 5.7% growth, house price index growth for the month of February alone, and almost 12% growth for the 3 months to February. So the orange line there indicates the house price index growth in the 3 months leading up to the current month. So it went from almost 12% in February right down to about less than 3% in July, then back up to 4%, then down to a bit under 3%, and then back up to about 5%, 5.1% here for October. And the 1 month result has gone from nearly 6% all the way back in February, which was the highest we've seen this year, I believe. I don't have January number at my fingertips, but dropped quickly since then and bumbling around sort of under 2% until October, where it hit 3%. So if we remember back to the previous slide, that median house price, that was an increase of something like 15% in 1 month. Well, clearly that's absurd. The underlying result in the last month in terms of the house price index suggests more like 3%. 3% is still a big increase compared to what we've seen for the last 6 months, nowhere near what is suggested by the median result on its own. So, what will happen in the coming months with the median house price, who knows? But I certainly pay more attention to this figure here, which does estimate the underlying values themselves rather than the mix of properties being sold. So as you can see there, we have had a big uptick in the last month in this measure also. And as you'll see in the coming slides, whilst this indicates a strengthening market, all the other indicators really point to a market that is slowing rather than a market that is strengthening. So as I say here in this starburst, yes, this is an increase in underlying values according to this index in October, but is this a blip or is it a trend? Well, until we see more data supporting this, I will call it a blip. So this is the new listings, and if you look firstly at this table, you can see here. So the month of October 2021, 876 new listings in the Wellington region versus 684 last year. That's a 28% increase on a year ago, and 757 in October 2019, 16% compared to a year ago. So these are big increases in the number of properties that have been listed in Wellington compared to the last 2 Octobers. If we look at the 6 months to October, 618 versus 595 and 592. So an increase, but only by a small amount, and that will be because the increase in new listings really we've only seen in the last 2 months. The 4 months before that was not significant increases compared to the two years prior. And so that moving average number, as you can see in the red line there, is only just starting to go up and is only just marginally higher than it was for the last 2 years, 6 months to October. But this is a pretty clear result here, and you can see the blue lines, massive jump up there, but see on seasonally adjusted terms, 28% compared to October 2020 and 16% compared to October 2019. So there's no question that all of that data suggests we are getting more property coming to the market in Wellington than we have had for the last couple of years. And that is obviously good news for buyers. On the number of sales side of things, now this is kind of a proxy for demand. It's not always reliable because the number of sales, regardless of how strong or weak demand is, or regardless of how strong it is anyway, will always be limited by how much stock you got on the market, naturally. But if you have increasing stock coming to the market, that allows for increasing volumes of sale, if indeed the demand is there to soak up that extra supply. What we're actually seeing is we had 700 sales take place in October versus 797 in October last year and 750 in the October previous. So this clearly suggests that there's a bit of a pullback. Buyers are noticing more properties coming to the market. Maybe buyers are being a bit more selective. We're certainly seeing, we haven't seen for quite some time properties go to tender day and not sell. Properties come to tender day and there are no offers. And we're starting to see a bit more of that. And this data supports that also. So certainly a significant reduction of 12% compared to October last year in terms of number of properties sold, and 7% compared to 2 years ago. So obviously 7% is less than 12%. And so that suggests obviously that last year, a year ago, was certainly stronger than 2 years ago. But in October this year, we saw less strength compared to both the last 2 Octobers. 6-month moving average basis, again, similar to the previous slide. It takes longer for the trend to become apparent on a 6-month basis. And so the data is less pronounced, if you like. So 11% down compared to 6 months to October last year, and only 3% down compared to the 6 months to October 2019. But nonetheless, it's still a clear trend, and that is fewer sales taking place in Wellington. Again, that is a sign not of the market strengthening, but of the market becoming less heated. Good news for buyers again, and perhaps the news for sellers is maybe we have passed the peak heat in the market. Obviously, things can turn around, but that's what the data is suggesting so far. How long is it taking to sell? 30 days in October 2021 versus 26 in October 2020 and 29 in October 2019. So again, 30 days is longer than both 26 and 29. That's quite a bit longer than 26, 15%, and only slightly longer than 29 at 3%. Again, on the 6-month basis, it's inconclusive. In fact, on this basis, 32 days, which is shorter than 6 months to October 2020 and 6 months to October 2019. But as you can see from that red line there, you can see that over the last year or so, the trend has been that the number of days it's taken to sell a property is slowly increasing. We had this really bizarre result last month of 41 days. I remember at the time saying this is unusually long, and I don't understand why it's taking so long. Perhaps a bit of lockdown hangover in Wellington, but yeah, back down to a more normal number in October. But the trend's still fairly apparent, a gradual increase in the length of time it's taken to sell a property. Again, this is consistent with the amount of properties coming to the market we're seeing being increasing and the number of sales decreasing, generally indicators that the market is cooling down a bit. Inventory. So again, you see here we got 7 weeks worth of inventory in October. We had 7 weeks in September as well, and prior to that we had 5 months where we had an eye-wateringly low 5 weeks worth of supply, the longest we've seen at such a low level. And so 7 weeks, that is still short in supply. The long-term average for Wellington is 15 weeks, so it's still very much a short supply situation, but it's more than we were seeing at any other time since February this year. Sorry, since it had to go back to January and February when we were last at 7 weeks. All the rest of the year throughout has been less than that until we got to September. So the last 2 months at 7 weeks. And again, interestingly, compared to October last year and October 2019, we have 7 weeks versus 6 weeks in both of those months. Again, whilst 7 weeks is low, it's not as low as 6, which is where we were for the last 2 Octobers. So again, more evidence that there is less heat in the market in October this year than we've seen in the previous 2 Octobers. And all of this is coming together nicely to show an interesting picture on the number of listings on Trade Me. Now, for a very long time, we've heard buyers just screaming, there's no supply, there's no supply, there's such little supply on the market. And that has been correct. It hasn't necessarily been because there have been no listings coming to market. And just in the same way that first home buyers have been screaming, it's so hard to buy a property, it's so hard to buy a property, whilst first home buyers actually have been taking up a larger than normal proportion of the market. In other words, more first home buyers have been successfully purchasing than has historically been the case, whilst at the same time, first home buyers screaming, it's too hard to buy a property. So the two are at odds with each other. In this instance, we're seeing, in spite of the fact that people have been saying there's nothing to buy, there's no supply on the market, and you can see there from this graph that has been correct. It has not been because nothing has been coming to the market. It has been because more properties have been selling than those that have been coming to the market. The number of sales taking place has been high. But what we've seen in the last couple of months, and this shows it nicely, is that in fact, we've seen the opposite happen. We've seen more come to the market and less sell. And so the available supply on the websites starts to swell, and you can see that going from September to October to November. And as of, I think this was yesterday, I collated this data, 1,707 listings on Trade Me in the Wellington region yesterday, compared to 1,307 in November a year ago. Well, that's a massive 31% increase. And even compared to 2 years ago at 1,697, it's almost the same, but ever so slightly more than we saw in the same period 2 years ago. And that increase, as you can see there, from really low levels for the last sort of 18 months or so, really since COVID lockdown happened the first time last year, we've seen a big increase in the last 2 months. Now, we do see increases seasonally, but it's been a while since we've seen an increase that strong, going from September to October, November. And you can see again, the 6-month moving average line clearly shows that is starting to drag. These last 2 months are starting to drag that number upwards. And so if this continues, then we should expect to see perhaps we could move back to a situation where we saw more like back here, where we had really significantly more stock on the websites than we've seen for a very, very long time. And that is indeed the way the market cycles move. So all of these add up to a reasonably clear picture, except for one of the bits of data, and that is in the increasing price indications. The median price, that's a huge increase. The underlying Real Estate Institute house price index also did increase strongly compared to previous months, obviously by not nearly as much. But this jump in median prices, this jump in price growth, is this a blip or a new trend? Everything else suggests not a strengthening market, but heat coming out of the market. So new listings, more new listings compared to October last year and the year before, less sales taking place compared to the same month a year ago and 2 years ago. Longer to sell a property compared to a year ago and 2 years ago. Inventory low compared to historical norms, but higher than the extreme lows we've seen in February through to August. Website listings increasing really quite rapidly. And so everything here points to a slowing market, except for the price growth increases. So it's certainly interesting times, and will be interesting to see what happens in the next couple of months. Of course, things get a bit strange as we head into Christmas. And so, we always see a pullback in listing volumes and a pullback in activity generally. But when the November numbers come out, that will still be interesting to see if this trend continues or indeed changes. But I certainly am finding it interesting observing and watching it unfold. So anyway, any questions? Happy to have a discussion, whether it's kind of related to this data or just anything generally. Real estate, just unmute yourself and fire away if you've got anything you want to ask or discuss.
Kia ora, Adam. Johan here. Thank you very much for your, not only the data, but your insights. I've got two questions. One is have you got a feel for breaking out apartment data from the housing and the terraces, etc.? And the second question is, I'm aware that most of the councils around the country were supposed to have updated their CVs in September of this year, and they're sort of delaying it. So what do you think the effect of these numbers might have on the CVs when they finally come out?
Yeah, okay, good questions. So 2 questions there. Let me answer the first one first. So what's my sense on the data in relation to apartments, right? So central city apartments. I don't have separate data on it, but just anecdotally, from my experience and that of my colleagues, 42 agents at Low&Co, and also my involvement with as an investor and with the property management business. Interesting, the apartments have become certainly less favourable to renters, and this is just, I think it's just typical COVID reaction. So tenants, like homeowners, want nice outdoor spaces, and so they felt they haven't had to be as close to their offices and so on, working from home, spending more time at home. They want a nice place to sit in the sun or read a book or have a barbecue. So gardens and courtyards and large decks and so on are in vogue. And so it's kind of a reversal, or at least a temporary one, of what was a long-term trend of migration towards the city and the convenience of being able to walk everywhere. People all of a sudden felt trapped in a box and wanted to break free of that. That has not flown through to the sales market to the same degree. Apartments are still going very well, but not all apartments. So what the apartments that are really going very, very well are those apartments that appeal to the first home buyers. So you got first home buyers who don't have children and don't have plans for children in the immediate future. They are all about getting into a property with as little deposit as I can, and that requires a property that is compliant with everything and low maintenance. So a property that is presented well in a building that is modern and purpose built, and the apartment is not too small. So if you've got anything from something like 50 square meters or over, and it's in an apartment that's well presented and modern and purpose built, and so the building ticks all the boxes mainly for the financier, the mortgagee, then the first home buyers are going crazy over those things. So we're seeing 50 square meter apartments selling for 750,000. Makes your eyes water. But properties that are in buildings with low earthquake ratings, with very high body corporate levies, because of insurance bills and that sort of thing, those properties are selling at a massive discount compared to those new ones. So they're not 20% cheaper or 30% cheaper on a per square meter basis. They're like 50, 60, 70% cheaper. It seems too extreme. It's not because the first home buyers who are driving that section of the market aren't willing to buy those ones. It's that their funders are saying, I'm sorry, I will not lend to you, so you can't buy those ones. So we have seen apartment prices and townhouse prices go absolutely crazy, just like good quality freestanding family homes with decent drive on and good outdoor spaces and all the rest of it. But in particular, it's been those apartments that are on the smaller side, not the great big ones, on the smaller side, in good quality buildings that are well located, well presented, and tick all of the boxes for the financiers, like the new building standard and the earthquake resilience, and no concern for leaking issues and that sort of thing. Does that answer that question?
Yeah, it does very well, thank you. And I guess the media, the stories about small apartments leaking and all of that sort of stuff doesn't help either.
Yeah. I mean, it's not just the small ones that leak. It's any of them. But yeah, that's right. But the other thing is that you get these dual key apartments, and those have struggled lately, and because they tend to favour the investors because they get the stronger income. Investors have pulled out, has seriously pulled back in the market for obvious reasons because of all the attack on their tax bills. And the first home buyers, again, they are quite happy to buy those things, but the lenders are saying, no, we need you to have a 40% deposit on those. And so the first home buyers are wiped out of the market for those properties. So those ones there are selling, or they're not selling because the vendors say, no, I'm not going to take the market price or the new market price for those ones. Those ones have suffered a bit in the last 6 months or so since the March announcements. Now your second question was, I can't remember it now.
CVs.
Oh yeah, CVs. So the CVs, the rateable values in Wellington will be as at the 1st of September. And I'm not sure exactly when they're going to come out. I have heard a rumor they're coming out on the 1st of December, but we'll see. What's going to happen? Those rateable values will increase massively. They'll be like 50% more, 60% more, 40% more, 65% more. There'll be a huge jump. Now, what typically happens in the market when the rateable values come out is that everyone gets totally confused. If the rateable values have a big jump upwards, so you got two sides of the market, the buyers and the sellers. The sellers all go, yeah, now that the rateable value has gone up by 50%, my house is now worth more, which of course is total fiction. The house is not worth more tomorrow because the RV went up compared to today. The house is worth the same tomorrow as it is today. But the fact that vendors all of a sudden think their house is worth a whole lot more has an implication in the market in terms of their expectations. And so their agent has to do a good job of keeping them with their feet on the ground in reality, and that can be hard without upsetting them. And then on the other side, the buyers, they get used to some kind of relationship on average between a rateable value and a sale price. Now, on a case-by-case basis, the relationship between those two numbers is tenuous at best, and you should really throw that any expectation that there is a relationship on a case-by-case basis away. But on aggregate across the whole market, there is a relationship between the average rateable value and the average sale price. And when rateable value goes up by 50%, and all buyers then think, okay, well, what does that mean for sale prices? They can become really hesitant to participate in the market, and a lot of them therefore step back and say, oh, now I want to just watch what happens for a bit, so I understand what that relationship is, because they feel nervous, so they exercise greater caution. And so certainly my advice to my sellers, as we're coming into the next few weeks, is we need to give clearer price indications to the market, because the buyers won't know they won't know what to conclude in terms of what is the likely sale price for this house by looking at the rateable value anymore. Not that they could before, but they thought they could, and so you could use that as some sort of indication. Whereas when the buyers become totally confused and pull back from the market, the risk is then we miss out on the buyers from engaging, and so to get them engaging again, we give clearer indications in the marketing as to what we're expecting the property to sell for, or at over this much, or using a BAO price and that sort of thing, rather than just selling by tender with the rateable value stated, because no one understands what that means anymore. I don't know if that's the sort of thing you were looking for, but that was the question or the answer that came to mind. Does that help?
Yeah, great, thank you.
Cool, awesome, good questions. Anything for anyone else? Oh, there's a question in here from somebody. And Anik, was that you again, or No. Do you think all these extra listings are of new builds? No, I don't. I mean, typically when you get a new apartment building, often you'll get one ad, and it's an ad for potentially 15 apartments. You'll get one ad for the 1 beds and one ad for the 2 beds or something like that. So often the number of units that are for sale is underrepresented by the number of listings on the websites. But no, we're just seeing more stock generally come to market. You know, some investors, not so much, but some investors selling a bit more, maybe. That's just me, you know, that's just anecdotal. But just generally more people selling. I think, you know, families sitting on big expensive family homes are thinking maybe this is the top of the market. Maybe it's time to cash out now and trade down and put some money in the bank. You know, so I think it's listings across the board. Yep. All good. That might be it. Thanks so much, everyone, for joining us, and I hope that was useful. If you need anything, sing out. You know how to get me. Otherwise, yeah. See you next month. Take care.